Let's talk about why your money is even safer at Wealthfront than it might be at your own bank. So FDIC Insurance protects the cash held in bank accounts up to $250,000 per depositor per FDIC-insured bank per account category. It is offered by the Federal Deposit Insurance Corporation, which was founded in 1933 as an independent agency of the US government. In the unlikely event that your bank suddenly lost your money, the FDIC would pay you as soon as possible, via either a new account at another insured bank or a check in the amount of your insurance balance. FDIC Insurance covers things like checking accounts, savings accounts, money market deposit accounts, and certificates of deposit. FDIC Insurance does not cover the following: stocks, bonds, mutual funds, annuities, life insurance policies, and safe deposit boxes. The federal government requires that most banks keep only 10% of all deposits on hand, meaning that the other 90% can be used to make loans. In other words, if you made a $1,000 bank deposit, your bank can actually take $900 from that deposit and use it to finance a car loan or a home mortgage. This is called fractional reserve banking, since only a small fraction of the total deposits are kept at reserves at the bank. How does FDIC Insurance work? If an FDIC-insured bank cannot meet deposit obligations, the FDIC steps in and pays insurance to depositors on their accounts. Once declared failed, the bank itself is assumed by the FDIC, which sells the bank's assets and pays off any debts owed. And when a bank fails, account holders get their funds back almost immediately, up to the insured amount. If their deposits exceed that limit, they will have to wait until the FDIC sells off the bank's assets to recoup any excess. Now, during the Great Recession, dozens of banks went under, right? In 2020, 4 banks failed. Still, since the creation of the FDIC, not 1 cent of insured deposits has been lost. The FDIC was created as part of the Banking Act of 1933 after a 4-year period that saw nearly 10,000 US banks fail or suspend operations. Most of these closures resulted from a run on the bank where the banks did not possess enough money in their vaults to meet depositors' withdrawals demands, and they had to close their doors, leaving many families without their savings. The purpose of the FDIC was to restore the faith of panicked Americans following the stock market crash of 1929 and onset of the Great Depression. The FDIC basically serves as a safeguard against future banking panics because the FDIC insures or guarantees the value of all bank demand deposits up to that limit. YouTube is a great place to learn all the financial 101 lingo that we never learned in high school and college. I'm here to teach that. Hit subscribe and follow along. So what is SIPC insurance? The Securities Investor Protection Corporation, on the other hand, is a non-profit membership corporation that provides insurance that protects the assets in your brokerage accounts. This coverage is limited to $500,000 in total value per customer, of which $250K can be cash, either from selling securities or buying them. Now, covered assets under the SIPC insurance include stocks, bonds, treasury securities, certificates of deposit, those issued by a broker and not a bank, mutual funds, and money market mutual funds. However, this protection only applies to SIPC-insured brokerages that are in financial trouble. It does not protect against decreases in the value of your investments due to market fluctuations or bad investment advice. But if your investment firm goes belly up and does not move your assets to another protected firm, SIPC will have your back up to the insured limits. SIPC does not cover the following kinds of investments: commodities futures contracts, foreign exchange trades, non-SEC registered investment contracts, and fixed annuity contracts. Now, some investors might feel nervous if their account value exceeds $500,000 because they're only insured up to that amount. We don't think you should worry, as it's very rare that SIPC insurance has to come into play. Because of the financial safeguards required by regulators, including a requirement to keep investors' securities separate from the brokerage's assets, it's highly unusual for an investor to lose their securities or cash when a brokerage goes out of business. It's only in situations when assets are missing that the SIPC has to step in to oversee the liquidation of the firm. For perspective, SIPC only had 2 new cases between 2014 and 2020 where they had to get involved because client assets were not fully available. So how does Wealthfront offer up to $2 million in FDIC insurance? Well, Wealthfront is not a bank, so we work with partner banks where we broker your deposits. Every partner bank we work with is FDIC insured, and we can offer you far more FDIC insurance on your cash account deposits than you'd get in a regular savings account because we sweep your money to multiple partner banks. At any given time, your cash could be at up to 8 partner banks, which is why you get up to 8 times the FDIC insurance that you'd get in a regular savings account. Previously, we swept your cash up to 4 partner banks. Now, clients sometimes ask us if their money is protected while it's in transit to or from a partner bank, and the answer is yes. This rarely comes up because we sweep your cash to our partner banks on the same day that we receive it. But even if your funds take a day to arrive, they're still well protected because our cash account is offered by Wealthfront Brokerage, a federally registered broker-dealer, and therefore includes Securities Investor Protection Corporation, or that SIPC insurance. And again, SIPC insurance covers up to $250,000 of your cash while it's on its way to a partner bank. So you're protected even before that FDIC insurance kicks in. So let's go over some FDIC insurance examples. Example 1, you have individual accounts and you do your banking in one place. And you have $50,000 in a checking account, $100,000 in a savings account, and you have $200K in a CD. That's a total of $350,000 deposited in one bank as one depositor, you, at one institution, your bank, and in one ownership category, single. If your bank were to fail, you're only covered up to $250K and you could lose technically up to $100K. Let's say you hold $350K in a Wealthfront Cash Account, earning a high APY. Because you're covered up to $2 million per account holder, you don't need to worry about it. We'll hold your cash in more than one of our FDIC-insured partner banks so you can receive the benefits of the higher limit. We don't really need to give another example. At Wealthfront, we take the responsibility to keep your money safe very seriously. We're delighted to offer far more than FDIC insurance than a regular savings account can. And this is just one of the many ways in which the cash account is far superior to what a bank is able to offer. The Wealthfront Cash Account is an ideal home for your short-term savings no matter what you're saving for. It earns a high APY, which is many times the national average, and comes with absolutely no account fees, including no maintenance fees, no overdraft fees, or transfer fees. So whether you're building an emergency fund, saving for a big purchase like a car or down payment, or just keeping money handy for your regular expenses, the Wealthfront Cash Account is a smart place to keep your cash and help it grow faster. The cash account also has the best in-class automation features, so you can organize your savings into categories, track your progress against your goals, and invest your money within minutes during market hours when you're ready to build that long-term wealth. And you can sleep better at night knowing that your money has far more protection in the form of FDIC insurance than it would at your bank. Thanks so much for watching. I'm Tony from Wealthfront. Take care.